All right, hey, it's Justin again. So today I'm going to talk about FHA versus conventional financing. There's different loan programs out there, but these are the two main programs for first-time buyers. Now there's VA loans, and if you're a veteran, that is the way to go, hands down. A beautiful, wonderful program. Thank you for your service. But if you're not one of the ones that have served the country and have the benefit of a VA loan, the next step is either conventional or FHA financing. So today I'm going to talk about the difference between the two, some things that you need to know. Make sure you watch till the end so that you don't miss any important information. And then also make sure you give me a like and a subscribe so that you're in the loop on my weekly videos that I continue with tips and tactics to help you towards steps towards financial freedom. All right, FHA and conventional. So what's the difference? So the main basic things are the down payment differences. So with FHA, that's a program that's geared towards first-time buyers that don't have perfect credit. FHA allows you to purchase a home with as little as 3.5% down payment and a FICO score as low as 580. Now, some lenders could get you with the FICO score, an FHA loan with the FICO score down to like 500, but you have to put at least 10% down or more. I wouldn't recommend purchasing a home with your credit being like that. I would recommend first having a budget, cleaning up your credit, putting some reserves aside, and just getting your finances in order before you take the step of buying a home, because you don't want the home to become a financial burden. You want it to be an asset and something that you thrive in. So again, that's a whole other topic, but with FHA, minimum 580 FICO score, 3.5% down payment. With conventional financing, you could actually do as little as 3% down, and different lenders varying. I think the minimum credit score for us is about a 640, and you can do a conventional loan. So the difference is why you would go to one or the other. Well, with the conventional loan, it's geared, you get perks, you get a better rate, a better payment, and a whole better loan package when you have higher FICO scores. The more money you put down, the higher your credit score is with conventional, the better the numbers are going to be for you. With FHA, you could put 50% down, you could have an 800 FICO score, a 680 FICO score, and the numbers are roughly going to be the same no matter what. The payment, the rate, all of that's basically, well, the payment will be the same if you're putting more money down, obviously. But overall, with FHA, no matter what your FICO score is for the most part, it's all going to be the same. Where with conventional, it's a big difference. It's a big difference, right? So the things I look at as a lender when I'm talking to a client and I gather all their finances, I run their credit, it's just a matter of putting it side by side. And there's the three things that you have to look at when you're deciding which one's best for you. Number one, which one's going to give me a better monthly payment, right? So you want to look at the payment between the two, because like I said, with conventional, the lower your FICO score is, the higher the rate's going to be, and the payment on it might be way more than an FHA loan. So you want to see which one's going to give you a better payment. Two, you want to see which one is going to give me lower out-of-pocket cost. You want to get a breakdown of the closing costs and out-of-pocket, what you're going to have to pay. If I want to buy a $400,000 property with FHA and a $400,000 property with conventional, what's my bottom line going to be if I want to do the minimum down? What's my payment going to be, right? So you want to compare the payment, and you want to compare what are your out-of-pocket costs going to be. And then last, you want to compare your long-term costs. You want to give your loan officer an idea of how long do you plan on keeping this home? I plan on keeping it forever. I plan on keeping it for 30 years. Or you know what? I'm moving to Texas, or I'm doing this. I'm going to get rid of this thing in 2 years. I'm going to sell it. So you want to kind of have an idea and give your loan officer an idea of your long-term plans. And you want to look at the cost over that period of time. If you're going to keep it forever, then you want to look at over 30 years, which one's going to cost me more and how much. And when's like the break even? When does one start to look better than the other? So you want to have a clear picture of the monthly payment. You want to have a clear picture of the initial upfront costs and a clear picture of the long-term costs. Once you have those in front of you, that's how it's usually easy to tell which one's going to make more sense for you. I hear some people saying, "Oh, don't do FHA. It's not the way to go." I hear investors say, "No, do FHA and buy a 4-unit property on your first home. That's the way to go." It all depends on you, your situation, and again, looking at those things to see which one makes more sense. If you have great credit, there is typically a breaking point. There's typically something that tips the scale towards one or the other, and what it is FICO score. If you have excellent credit and you're doing 3% down, conventional will probably look a lot better than FHA and save you in the long run. If you have lower credit with low down payment, FHA is probably going to look a lot better on paper as well. So it just depends, right? And it's finding that tipping point and then making sure you have a clear comparison of what they look like side by side. Another big difference is mortgage insurance. So with low down payment, you're going to have mortgage insurance. With conventional loans, there's lender paid mortgage insurance, there's borrower paid mortgage insurance, and there's upfront or single premium mortgage insurance. So if you hear a lender saying you could buy, get a conventional loan with no PMI, typically it's because there's a somebody's paying that premium for you, and you're maybe getting a higher than market interest rate, or you're getting more closing costs. But with conventional loans, you could buy out the PMI up front. You could have the lender pay it for you and you get a higher interest rate, or it's in your monthly payment, right? And another thing about conventional mortgage insurance is once your balance on your loan hits 78% of the price you paid, the PMI will automatically come off. You can prepay your balance down, you can make extra payments, and once you pay your balance down to where it hits 78% of the original price you paid, the PMI comes off. Now, even if values tank, let's say the market tanks, your value gets cut in half, it doesn't matter. It's still gonna automatically come off when your loan balance hits 78% of the original price you paid, no matter what's going on in the market. Now, what if values are shooting up, they're going crazy? Can I get it removed early? Yeah, with conventional loans, you can get your PMI removed early as long as you have the value there. It depends whether you've had that loan for 5 years or less, or 5 years or more. That'll make a difference. If you've had it over 5 years, as long as you could show that you have 20% equity, you could appeal to get it off early. You'll have to pay for an appraisal, but you won't have to refinance or anything. If you've been in that home less than 5 years, you actually typically have to show 25% equity to get it off early. But there's typically no cost for that. You gotta pay for an appraisal to show the values there. But for the most part, again, to get the PMI off early with a conventional loan, if it's been less than 5 years, you'll need to show about 25% equity. And if you've been there over 5 years, you just need to show 20% equity. Or you could sit back and do nothing, and it's going to come off on its own when your balance hits 78% of the original price. So with an FHA loan, the mortgage insurance is completely different. If you put less than 10% down with the FHA loan, the mortgage insurance is going to be there forever. So until you refinance or pay it off, so no matter what the value does, no matter what happens in the market, that PMI is always going to be there on an FHA loan for a long time, forever, until you pay off the loan. If you put 10% down or more, even if you put 50% down, you are still going to have the mortgage insurance with an FHA loan for 11 years. So after that 11 years is up, it's going to come off on its own, no matter what the value does, but it's minimum 11 years. The only way to get rid of mortgage insurance on an FHA loan is by refinancing it or putting 10% down, and it'll come off on its own at the 11-year mark. So that's one of the downsides of FHA, is that PMI will be there for a long time. But again, when you compare your FHA loan to your conventional loan option, you could look at the long-term costs, and that'll all be factored in there. So you could still see the long-term picture and make sure you know which one's going to cost you more or less in the long run. And again, if you have lower FICO scores, it still might be better to go FHA. It might cost you more to do conventional up front and in the long run. So something to consider. Another thing with FHA is there's what's called an upfront premium. So you have to pay an upfront premium on top of the monthly. So FHA charges 1.75% of the price or of the loan amount as an upfront premium. That gets added to your loan. You don't have to pay it out of pocket, but that's an extra cost of getting an FHA loan. Where with conventional financing, you do not have that upfront premium. So with FHA, you have an upfront mortgage insurance premium of 1.75% that gets added to the top of your loan. Plus you have the monthly forever, or until you pay it off or refinance it. Unless you're doing 10% down, then it's 11 years. With conventional, there is no upfront premium. You just got the monthly, and then there's some options within that. There's more flexibility. So those are some differences there. So that's it. It's a lot of information. It's really hard to try to put all of this in a video and walk somebody through it. The best thing to do is just sit with a professional and find out which one's best for you. And like I said, just look at what are the monthly costs, what are the out-of-pocket costs, and what is this going to cost you in the long run? And once you compare that side by side, it usually stands out which option is going to be best for you. If you have any questions on this, feel free to message me anytime. Otherwise, again, make sure you like and subscribe as I keep putting out weekly videos to try and help everybody on their path towards financial freedom. Thank you.